Well, gold has outperformed really all markets now. And when we look at gold, it's also recorded highs in all currencies. The main reason, of course, is the uncertainty with respect to the economy. We have, of course, the Trump administration, and that has caused a lot of uncertainty. But more important, there's a global uncertainty, and that's driven people to gold. We also have the central banks. I think I mentioned many times that the central banks have bought up something like 20% of the world's supply of gold. And then the third reason is China. China has been the big kahuna here. They have returned to the markets. They have, in fact, said internally to their insurance companies, you can now buy gold as part of their portfolios. So there's a lot of gold buying, and there's a scarcity of gold. The gold industry itself is not producing as much gold as they used to. So we have a squeeze going on. And that squeeze is reflected in fact, I think I mentioned before that there has been a movement from the London warehouses to the New York warehouses in hundreds of tons of gold. One of the reasons, of course, is the fear of tariffs, and that has caused the repatriation of gold. But there's a lot of physical gold movement back and forth, and I think there's a shortage of that supply, Andrew.
This was gold's highest weekly US dollar close in history. Swiss gold bullion flows into the USA recently, represented by those large purple bars on the far right of this chart, illustrate that nearly 400 tons of physical gold has flown in from Switzerland since December 2024 last year. Of course, there has been more gold from other places that has come in. The big Swiss 4 gold refineries are probably operating at max capacity of about 250 tons of gold per month. Of course, there are lots of other gold refineries in particularly BRICS nations like Russia, China, and South Africa. But in terms of Western world gold-friendly refineries, Switzerland is the big gold refiner bottleneck. We're not even done with Q1 2025, and already half of the LBMA's gold price high guessers on the year have been blown by before the first quarter even ends. For bullion bull markets, surprises typically come to the upside. Now we have Citibank dropping notes, bull casing gold to possibly pop to $3,500 an ounce by the year's end. Now we'll discuss volatility from here to there and higher shortly. But I got to give Citi credit, at least they dared to put a 3-month call out there. At the same time, the U.S. Office of the Comptroller of the Currency published the fact that they've also increased their U.S.-based precious metals derivative book by an additional $15 billion notional, while both Bank of America and JP Morgan reduced their overall U.S.-based precious metals derivative books by larger total sums. Thus, the orange bar fell to the end last year. Of course, nobody really knows these and other major bank respective precious metals positions over in London and in other derivative market makings around the world. And that's part of the ongoing problem of this opaque industry at large. A little later, we'll go deeper and literally hear from someone whose career was working on those kinds of large commercial bank desks. For now, remember the closing words of longtime London gold market trader Peter Hambro, whose July 4, 2022 admission article originally published on London-based Reaction website and was recently deleted off the website about a month ago as gold withdrawal delays were embarrassing the Bank of England, and such admissions were likely not helping its growing public relations folly. Back when the U.S. OCC began publishing U.S. precious metals derivative trading data in July 2022, Peter Hambro warned to close his piece with the following words. Gentle folk, look at this chart and then go see your bullion trading counterparty and buy some gold. Then ask for your gold or silver or platinum or palladium or any other physical store of value and medium of exchange that you've acquired to protect you from the ravages of inflation. For inflation will surely engulf the world when the paper gold emperors close are seen for what they really are. This week, Daniel Galley went back on BNN Bloomberg to hammer home some solid points about gold's building FOMO trade west versus eastern world. Have a listen.
I think, central bank buying activity in gold has been a secular trend. So if you look through history since 2010, I'd say The breadth of central banks buying gold has started to increase. And the fact of the matter is there's a really wide variation as to why these central banks are buying it. The de-dollarization narrative has been spoken about. More recently,
some countries just not wanting to own U.S. dollars.
Or to diversify away from the U.S. dollar, partially. But I actually think that what's been more relevant in that stream of buying activity in gold this year has been buying gold as a currency depreciation hedge. So if you think about the start of the year, we actually started off the year with a pretty stellar rally in the US dollar. This is very counterintuitive, but if you're a country who wishes to diversify away from the US dollar, you might take advantage of those moments in time when the US dollar is pretty strong in order to sell US dollar denominated assets and buy non-US dollar denominated assets, one of which is gold. So that currency depreciation pressure is really what counterintuitively has been fueling central bank buying activity in gold this year. And in the latest rally, that's no longer the case. Right, over the last few weeks, the dollar has weakened substantially. So we think this mystery buying activity, which we've dubbed it as, has stepped away. But here's the beautiful part about the setup in gold this year. You actually have almost perfect diversification in terms of the large drivers of gold buying. On the one hand, we spoke about if the dollar rises, central banks, mystery buyer steps in. But when the US dollar subsides, the Western investor cohort also tends to buy gold. That's the traditional case for purchasing gold.
Inverse relationship.
The inverse relationship to rates, to the dollar, and so on and so forth. So that's what we think is really occurring today. In fact, this is a setup that should really fuel fear of missing out in gold, because macro funds have liquidated a substantial amount of their holdings over the last weeks. And as gold prices break into new all-time highs, they have to reallocate into it.
Last week, I flashed this chart that illustrated the bad start of the year to the fiat US dollar in relative terms. It's actually one of the worst on record going back to 1995. On the other side of the world, people in Vietnam are FOMOing into long-hour lines to buy gold bullion and gold rings. Literally buying what they can get according to local store buying limits, ranging from buying limits of 1 tau or 1.215 troy ounces to just 1 gold ring limits. Quote, I have spare cash and do not know what to do with it. So buying precious metals with extra cash is common in bullion bulls, and the Vietnamese are doing just that. And that will increasingly keep happening there. And I can say that confidently just glancing at their long-term local silver price chart, which is yet to blow beyond its 2011 nominal high. So gold is going to keep marching higher as silver eventually plays catch-up later on. Now, probably the craziest story of the eastern side of the world this week was the admission that the Indian government is naked short 13 billion notional on a silly gold government-backed investment option that is blown back into their face in myriad ways. In 2015, India's finance ministry introduced a sovereign gold bond program to reduce gold imports and offer returns linked to gold prices. However, the program turned costly as gold prices surged, resulting in significant government liabilities. Taxpayers now face the burden of these rising costs, with the plan not curbing gold imports effectively. In terms of India, an outstanding 13 billion naked gold short loss is like 1 month's trade deficit sum at the moment. And they'll just probably debase the fiat rupee further. Same old story. It's pretty ironic because the Reserve Bank of India, India's central bank, in 2013 admitted that the global gold market at the time was paper levered 92 ounces paper to 1 ounce physical. And here we are a dozen years later, with India eating their paper promise losses galore as local Indians continue buying real physical gold and silver in size that only this century China in gold and the USA in silver can match in tonnage terms. Stick around. On the other side, we're going to go deeper into past bullion bull market data and also get a listen to a former major commercial bank desk manager's reason for being bullish silver bullion to come. Hello there, this is James Anderson on behalf of SD Bullion with your weekly bullion market update. Please smash the like button, subscribe, and share this content with those who also might find value. Before we continue with this week's bullion price action and other news, a quick reminder about SD Bullion's new IRA streamlining service offering.
like, oh, sir, this could take 4 to 6 weeks. And man, this process is really broken.
What we've done at SD Bullion is we've taken everything under one roof. Transparent pricing, you know exactly what you're getting. All the metal comes into our facility under camera. It never leaves. If you want to sell back, if you want to take a distribution, these processes that would take you 3 to 6 weeks to do at another program, we'll ship that out in 1 to 3 days after you decide you want to do that.
The silver and gold markets had mixed performance this week. The spot silver price did pop briefly over 34 an ounce intra-week, only to get back nearly $1 an ounce to close just over 33 an ounce bid. The spot gold price got another highest weekly close achieved, with spot finishing at $3,023 an ounce bid this week. The spot gold silver ratio climbed on silver's relative weakness to a still stubbornly high level of 91. In terms of other bullion bull markets past and behind us, the late 1970s version also had a stubborn spot gold silver ratio channel that it battled within, albeit more than half the version that we currently find ourselves seemingly locked within. Back then it was a 40s to 30s spot GSR range, with gold outperforming silver from 1976 through the end of 1978. But then by February of 1979, silver got its running shoes on, blew through its $6.50 an ounce cup and handle, and went on to outperform gold by a factor of nearly threefold over the following 12 months. Silver also frustrated its bulls back during the October 2009 to August of 2010 QE era. I lived and traded through that. It seems we have a similar spike and sideways channel now, just larger and higher than ever experienced prior. This week I went on Palisades Radio's YouTube channel where I did my best to squash exuberance and take the longer view of where we are and where we are likely going long term with this bullion bull. For me, the bigger picture, it's our Ponzi record debt markets, ongoing record deficit spending, fiat currency proliferation worldwide, U.S. stock market bubble, mass hundreds of trillions in Western world unfunded liabilities, and other factors that more than give away any long-term bullion bull courage to buy big price dips along our way higher. In other words, in my opinion, until these major points just mentioned get rectified by sharply revaluing bullion on a relative basis, it's a bullion bull market ongoing. Well, that said, every major bullion bull market and bull run eventually return to their 200-day moving averages, and at times, like the 2008 global financial crisis, it can even nominally dip well below such levels while the wholesale and retail bullion market runs dry of inventory and goes into extreme premiums on products with long delivery delays. Seeing something akin in our unknown future is highly likely, given that it's happened in our past. Here's one lingering concern I have, and the full interviews link I will leave in the show notes below. Have a listen. One caveat I think that people need to keep in mind is that the shorts on the gold side inevitably will drive this thing back toward the 200-day moving average. The 200-day moving average is 2,620 some odd right now an ounce. And you have what's sitting out there is the Russia-Ukraine war. And I would assume, I would hope, at some point we get a ceasefire and at least an accord and we get some peace there. And when that occurs, I would expect a massive short drive down on gold. And you'll see gold dip below 3,000 an ounce. And it'll scare a lot of people out and thinking, gold, that's the peak. That's as high as gold will ever get. Mm-hmm. But the people who think that haven't actually studied gold. The problem is that most gold has been, the history of gold has been taken out of business curriculum since the 1970s. And so most people that comment on financial markets have absolutely no idea about anything about gold. They've never done any research. They don't know anything. They're basically illiterate when it comes to gold. They don't understand why central banks are buying in record sizes in the last 3 or 4 years. They don't understand that basically the gold bullion bull market is a run to bullion over bonds. And the bond market is the biggest market in the world. So if you get flows from the bond market into bullion, that changes everything. You basically get a phase transition where all of a sudden gold reasserts itself as numero uno and bonds take a second seat. I mean, bonds were in a bull market from the 1980s until the late 2010s, right? You would expect that there are 40-year bull market for it to have a secular bear market that goes at least 20 years, right? And so that's 2020 to 2040. I think in that time frame, you're going to see gold reassert itself and do something for the history books. This is the U.S. government's rigged CPI data going back to when the inflation data rigging began 1980 onwards, back when gold almost broke the system last. Expect to see this nonsense chart again as gold eventually goes towards $3,500 an ounce. Of course, shadow government statistics, which claims to use the old 1980 CPI methodology for measuring price inflation ongoing, they have the 1980 gold price high at just below $30,000 an ounce looking backwards. I know, to normies, and even to our eyes, it does sound crazy, but if we take into account outstanding U.S. debt coverage at the time, January 1980 versus U.S. official gold reserves valued back then, well, the data jives. Now, the silver side of the rigged CPI data even still has a 1980 high price for silver at $170.50 an ounce, using data at the end of January 2025 looking backwards to 1980. And this is merely using the U.S. government's increasingly rigged CPI data looking backwards. If we involve the shadow statistics government charts, it goes into a four-figure number that I'm not going to publish here because it's embarrassing. Bottom line long term, bullion is still relatively cheap given all contributing factors at the moment. Now to close, we're going to listen in to a March 12, 2025 interview conducted by the Silver Institute with Robert Gottlieb, who has been an outspoken silver bullion bull of late, mainly posting his thoughts on LinkedIn. Now, this is perhaps the first time he's spoken to retail investors in such a public format. I'm going to link the full interview in the show notes below, but we're going to try and splice in the most important parts to close this week's bullion market update. Now, forewarning, it's a deep commercial bank desk coverage conversation. Try and follow along the best you can. I think you will find some good insights.
Welcome to the Talking Silver podcast. I can't think of a more appropriate guest given what the precious metals market, in particular silver and gold, is facing today. And I just want to get a better feel from you on your background before we get into the nitty-gritty.
Certainly exciting times, Michael. Obviously gold on near all-time highs and silver acting extremely positive as well. I had a long-term background in working in the bullion banking business, worked at JP Morgan, HSBC, Citibank. I guess what I'd like to start with is what a bullion banking business is and what they do. And from there, we can expand on obviously the different roles and obviously all the different factors that are happening in the market today. Bullion banks basically they act as intermediaries between miners, refiners, central banks, investors, and end users. Bullion banks, most of them are market makers. They buy and sell gold in large quantities, and their role is to provide liquidity to the market. They also store and custodize gold. They're heavily involved in lending and leasing, which is extremely important because the lending and leasing basically supports end users, investors, refiners, miners, and so forth by hedging and risk management. One thing that I've specialized over the years is running arbitrage books. And that simply is running the differential between the London OTC markets and the CME, which is a futures exchange. Generally, banks, if you take a look, are short the CME, which is the futures exchange. Against that, they are long the London OTC. So many times I've seen in the past, the banks are short the world supply of silver, and it's only really being reported one side of the transaction. The other side of the transaction is the long OTC or long forwards, and that's the part of the hedging and risk management that they do as a bullion banking business. The reason why banks are short, generally, especially in a bullish market on the CME, is because they're able to source metal cheaply through what's called an EFP, which is an exchange for physical, where you buy London and you sell futures. And that's due to different players in the market, for instance, the managed money, CTAs, that are long and take these long-term or short-term positions in the metal are levered. They just buy futures, and while they're buying futures, the other side of that transaction is that the banks will be selling the futures to them while simultaneously buying the OTC and sourcing metal.
So we're seeing a lot of that today, right, Bob? I mean, since the election in November, there's been a lot of talk about potential tariffs. To a large degree, those tariffs have come into play on both Canada and Mexico. We're starting to see a few carve-outs, a few pauses with the official effective date. And, today we had sort of a reprieve for Mexico. The automakers have received a reprieve. But, those who follow the silver market and the gold market are well aware about the EFP issue. And can you explain to our listeners what is taking place with these large shipments of gold and silver from London to New York, and what is the purpose of that beyond trying to avoid a tariff?
Yeah, of course. That's a great question as well. And the key to that is if and I don't believe that tariffs should be put on gold and silver. First of all, they're monetary metals. And my position always has been that monetary metal shouldn't have a tariff. I was immediately shown wrong when President Trump put a broad brush tariff initially on Mexico and Canada and involved anything coming into the country, which included silver. And as you know, in silver, Mexico is the largest producer in the world, so it would have a major impact if there was tariffs put on silver for silver coming into the U.S. Now, you have the threat of tariffs. Let's say a tariff, for instance, we're talking 10% tariff. If the price of silver today is $33, that means that break-even cost of tariff would be $3.30, simply 10% of the price. So if you were importing into the U.S. silver and you had to pay that 10% tariff to get that $33 ounce metal, you would have to pay a $3.30 surcharge. And what happened was in November, when President Trump was elected, the threat of tariffs obviously was a topic that was on everybody's mind, and he was threatening to tariff the entire world. What happened then was that the market started to price in the possibility of tariffs. And initially, that happened late November. And I actually started pinpointing that on some of my LinkedIn posts on analyzing, the threat of tariffs. And even if you don't believe that tariffs would be implemented, how much pain could, as I described before, all the banks are short the CME, long OTC London or forwards, so they had the wrong position for if tariffs would be implemented. So what happened was initially the differential or the EFP started to move out to partially price in the cost of a tariff. And with that, there started to be some pain as far as on a mark-to-market basis from banks and hedge funds that thought these were great positions, because what you could do is you could buy spot London and, let's say, sell the CME at maybe 2% above money. And then they were able to lend that out at maybe 2% under money and make 4% spread, which was quite uncommon. And that's what actually happened in the beginning of November, middle of November to December. Then I think people realized that there was a bigger chance of tariffs to be implemented, and people started reversing out of these positions by either just reversing out of the EFP, which would be just simply selling spot, buying the nearby futures month, or by physically moving the metal. And what you have to do then in the case of silver is you have to move silver from overseas and like bars for the CME's 1,000 ounce bars and move it in. And what we saw was since, let's say, December 12th, we saw 109 million ounces of silver shipped in. To give you an idea how much that is, during COVID, 83 million ounces were shipped in. So we've already surpassed the shipments that were done during COVID time.
That's amazing. I was going to ask you that question. So we haven't seen anything like this in the precious metals market since COVID, right?
No, definitely not.
And in your career, have you ever seen anything like this? What about like a 2008 financial crisis or anything of that nature?
I don't remember that we would have seen this size shipments. And this is strictly due to the arbitrage difference in the EFP and people pricing in.
Sure.
People pricing in the potential tariffs. And then also people, the risk managers, for instance, at the banks and the hedge funds have, they don't have that short-term memory to remember the initial losses that happened in COVID when they thought refineries were going to shut down and planes were going to not fly, and therefore you wouldn't be able to physically close out, your short positions. So what happened was, I call it the pain trade. You could be right that there are no tariffs. However, if the market believes there are tariffs and the EFP starts to move out, how much loss as a bank or a hedge fund can you take before you say that's enough and I'm going to cover that position? Right. And that's what I refer to as the pain trade, and that's what actually happened during just December through now. You've seen a tremendous amount of flow, and that's either people cutting their losses, and then subsequent to that, when EFPs have moved out drastically and they're able to get physical, then they're able to lock in some profits by putting on, like for instance, the silver EFP, which is trading today at 57.5 cents roughly to May, actually traded out to $1.20. So you were able to buy spot, sell the nearby futures at $1.20, and your cost of shipping, to give you an idea, is somewhere between 8 to 18 cents, depending if you're going to go by boat or plane. And the cost of funding, you still had significant profits by putting on this position and then moving it. So what we've seen is a combination of profit taking and also minimizing losses.
How much silver is actually left in London right now? I know that stocks have been drawn down significantly.
Yeah, that's a great question. And a colleague of mine, not that I worked with, but somebody has done some really good work, is Daniel Gali from TD. He's their strategist. And he's done an analysis on free-floating silver in London versus silver that's sitting in the London clearing system but can't be used. And what I mean by that is if the silver is allocated, for instance, against SLV, which is one of the biggest silver ETFs, that is backed by physical allocated silver. So even though that silver is in the London warehouse, it cannot be used in any way, shape, or form. Now, the analysis, using Daniel Gali's analysis, over the last 5 years, the average daily trading spot of silver is 250 million ounces. And his free float, if we went back to August of, let's say, 21, was around 500 million. Today, his estimate is roughly 247 million ounces of free float. Now, if you take a look, that's awfully close to every ounce that is traded during the day. And it's technically lower than the 247 free float is less than the 250 million that trades each day. So with that, silver forwards have become extremely tight. Between the 100 million ounces that physically has been shipped into the CME, and then what's left to borrow is not much. And what's very important is if you take a look at silver versus gold, gold has the same exact distortion, except for has the same exact tariff situation, but is not as distorted as silver. And the reason for that is that 20% of whatever has been mined in this world in gold is held by central banks in their reserves.
Right.
And you basically can go to what I call the lender of last resort, which are central banks, and go out and borrow gold from the central banks.
Okay.
And that would suffice any shortfall. But
Okay.
there is no lender of last resort in silver. So
Got you.
what we've seen, and we've seen it happen just in the last 3 days again, is silver has gotten more distorted, and the silver OTC rates are roughly around zero, which
Okay.
means the implied lease rate is the cost of money. So SOFR, which is the new LIBOR, is roughly 4.3%. So at a zero OTC forward rate, your implied lease rate for borrowing silver is 4.3%. And you're
Okay.
talking about a metal that had a zero lease rate for many years.
Right.
So,
Exactly.
you have many people that will be listening today that are just buying silver bars, silver ingots, or buying SLV, which is the silver ETF, which is backed by silver.
Right.
So
Sure.
anytime, there's a extra demand in silver, it may require a creation in the silver ETF to take the additional demand away.
Okay. This activity that we're seeing today, can it positively affect the silver price down the road?
Yeah, I as many people probably know, I am fundamentally bullish, both gold and silver, medium and long term. And my opinion has been quite clear that I felt that silver was going to have a catch up against gold. And the reason for that simply is we discussed the demand supply equation of silver and the free floating stock, which is becoming close to zero. And with that, silver lease rates are 4 to 5%. To the extent that silver lease rates continue higher, people aren't going to be able to afford to borrow silver. They're going to have to actually end up buying it.
Right.
That's the only access. And that makes this fundamentally bullish to me. The one question I have for you would be what analysis has been done on the price sensitivity of above ground silver. I mean, I've read so much about
Right.
silver being stored in the bunkers, and depositories. What at how high of a price would it have to be to get some of these above ground silvers back into the flow?
Sure.
And
that's a great
obviously,
question. That's a great question to me, and we'll conclude with this. We did just last month release a report entitled "The Price Sensitivity of Above Ground Stocks," and I encourage those in the silver market, whether you're just an interested bystander or you're actively participating in the market, to read this report, because it goes through, quite frankly, how complex these above ground stocks are. And we do maintain that there's no correlation between the overall level of above ground stocks and the silver price, but we also mention in this report that movements in bullion stocks do have an impact on the silver price. So there are little nuances with respect to the nomenclature in the market on above ground stocks. But it's a long report. It's very well done. It was done by a leading precious metals analyst, Philip Klapwick, and we hope to have him on a podcast down the road. But Bob, is there anything else you want to add? I'd like to thank you firstly for participating. And
no,
our listeners are going to be really welcome this.
Now, I might have left a dozen minutes or so of market trader positioning minutia on the cutting room floor, but I did leave what I thought was the most pertinent points in our SD Bullion market update this week. And of course, that was a long-time industry leader in his own words for us to hear and take in. Now, the full link to that 28-minute podcast is in the show notes below for those who want to listen to it again. That's going to be all for our weekly SD Bullion market update. And as always, to you out there, take good care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new Bullion market updates.